Okay, folks, let's get settled in. Yeah. Okay, come in and get settled. Couple of notes. Come on in, folks. Couple of quick notes on the quizzes. First is, don't compare your answer to your neighbors. They might not match. Now, as you know, there were two different quizzes. Actually, let me take that back. There were two versions of the same quiz in the sense of what the problems look like, except in one it was foreign, in the other it was, so basically, different currencies. So, but the numbers would have been different in each one. Which means if I get the perfect answer to the wrong quiz, you are completely and totally in a position indefensible. How you got the other person's quiz perfectly right, it's happened twice in the last 5 years. And you know what? And I remember when I confronted the person about it, they said, that was very tricky of you. I said, what's the damn trick? I gave you a quiz. Do the damn quiz that's in front of you, not your neighbor's quiz. So hopefully none of you have gone down that road. So that's the first. The second is I asked all of you to write your names on the back, and here's why. Here's what's happening as we speak. The quizzes are being alphabetically sorted. The TAs, that's what they're doing right now. So at noon when I get back to my office, there'll be this big stack on my office. And then the rest of my day begins. I'll grade and I'll grade and I'll grade. I have to take a break. At 3:30 I have to teach a class. It's tough to grade and teach the class at the same time. Then I come back and keep grading. And when I'm done, I will email you saying, I'm done. Come and pick up your quizzes. I'm probably violating 15,000 NYU rules when I do this. But I'm not sitting there with the quizzes in my office and handing them out one at a time. I mean, that's a logistical nightmare. I'm not bringing them to class. That'll eat up an entire class. I'm going to put them face down in alphabetical order, right in front of, so I'll tell you where to find them. They'll be in front of the finance, so as you enter they'll be on a table to the right, in 3 alphabetical stacks. Hopefully you know what your last name's first alphabet is. Just pick up your exam. Do not browse. This isn't Barnes and Noble. So don't say, I want to see what other people got. I will send you the distribution if you're that interested in what other people got. Just pick up your quiz, and then here's what I'd like you to do. When I send you that email saying your quizzes are ready, I'll send you my solution sheet with my grading template. And you can check to see whether I've been unfair to you. And if I've been unfair to you, or you feel I've been unfair, bring your quiz in. Don't bitch and moan about it. Don't stew in your own juices. If I screwed up, I'll fix it. Okay? If I make a mistake in your favor, don't be crazy. Don't bring it in. Just keep the damn thing. Think of it as a gift from, up above. You have a lucky day. But if it's a mistake that works against you, bring it in and I'll fix it. Okay? So wait for that email. It'll come sooner than you think. Okay? And then come pick up your quizzes. The other was I sent you the case for the class last week. You have no idea what I'm talking about. I can see that with the blank looks I'm getting. What case? I don't remember this. So I will remind you again, and I'll tell you where to get it on. It is a group case, and it's a case that every spring I write a new case. So last year it was the Apple iCar. The year before was Nike Apparel. The year before that, a Home Depot Expo. So basically, furniture store. For this year, it's Netflix entering the content business in Asia. So what I do is I'll give you all, the case is basically all the numbers you need and all the facts you need. And you work on it as a group and you have a singular mission. You got to tell me whether Netflix should make this investment or not. You can use whatever tools we have in this class at your disposal. But I want you to decide, not to pass the buck. Okay? So read, I know it's the spring break is coming, you've just finished the quiz. The last thing you want to do is even look at the case. My recommendation is at least read the case before you take off for wherever you're going on spring break. Let it fester. That's the wrong word. Do whatever it does in your brain. Let it sit there for a while. And then when you come back, the case is due, I think, March 30th. So it sounds like a long ways off, but by the time you come back from the spring break, it's going to be, 11 days or 12 days left. So my suggestion is at least get the process started. Okay? That's about it. So let me go back to where I left you on Wednesday. I know you don't remember this, but we were talking about getting a beta for a private business. And I was using Bookscape as my example. And I came up with a sample of 11 companies. You're saying only 11? Remember, she gave me only a $100 book certificate. This is about as hard as I'm going to work for $100. I said 11's good enough. The unlevered beta for being in the book business is 0.7584. Up till now, I've done exactly what I did for Apple, right? Come up with the unlevered beta for the business. Remind me again with public companies what I do next. Once I get the unlevered beta for the business, to get the beta for the company, I look at the debt to equity ratio for the company. And what debt to equity ratio do we use? A market debt to equity. Do you see the problem I'm going to face now? This is a private business. There's no market debt. There's no market equity. So here's what I did. I picked up the phone and I called this lady who owned Bookscape and I said, do you have a target debt to equity ratio? She said, a what? I kind of answered my question. I hung up the phone. Because if she'd said 30%, I'd have plugged it in and moved on. I've never, in all my talks with private businesses, ever got an answer from a private business owner that I can actually use. Because private business owners don't think in market debt to equity numbers. They might give you a book debt to equity, or they'll say, I'll tell you when I can't get an answer I use. The private business owner says, I never borrow money. Some private business owners are dead set against that. That makes my life easy. But in this case, she said, I don't know. So here's what I did. I took the debt to equity ratio of the public companies in the space. Do you see what I'm assuming? That if you're a private company, you're going to have to operate under the rules the rest of the companies operate in. I plugged in that 21.41% debt to equity ratio and came up with a levered beta for this company of 0.8558. Remember, her mission to me was, give me a hurdle rate, a rate of return. I'm almost there, right? I've got a beta, I've got a risk-free rate and an equity risk premium. I came up with a cost of equity of 7.5%. I almost called her and gave her this answer until I remembered something about betas. What kind of risk does beta capture? Market risk, right? What do we assume about the rest of the risk that allows us to be so cavalier about ignoring it? In public companies, we assume that that risk gets diversified away. Not by you and I, but the marginal investors in the company. But this is a private business. So I have a question for you. That 7.5% is my cost of equity if I think of this as a public company, but it's not public. Remember how she started the conversation with me. She said, I'm going to take the rest of my savings and put it into the bookstore. What's she telling you? If she does that investment, all of her money is going to be invested in this bookstore. So I have a very simple intuitive question. You have risk-free rate, beta, risk premium. This is how we're taught to do cost of equity in almost every finance class. If I use that to come up with the cost of equity for a private company, am I going to underestimate her required rate of return or overestimate it? Everybody get it? I'm going to underestimate. Why? Because I'm counting only that risk, that's market risk, and I'm saying don't worry about the rest. Why? Because it's going to get diversified away. You know what our answer is going to be? By whom? I've got my entire wealth tied up in it. I'm going to be exposed to the rest of the risk as well. Algebraically, do you see what the problem is? I'm counting only a portion of the risk. If I can somehow bring the rest of the risk in, then I'll get a more realistic cost of equity. So this is the problem that private appraisers have faced for as long as they've been valuing companies. So I remember the first time I talked to a group of private appraisers. It was in New Orleans for a conference. I was giving this talk. And I didn't know how they dealt with this fact that all the risk and return models in textbooks are for public companies with diversified investors. And I said, what do you do about the fact that with private companies, you're going to come up with these costs of equity that are too low? You know what their answer was? We add 10%. Which means you take the 17.5. And I said, why 10%? And of course, you know the answer to that. It was here when I got here. It struck me as a remarkably bad way of adjusting cost of equity. One number fits all. So I said, there must be a better way to do it. So I was writing one of my investment valuation books and said, let me think of a better way of doing it. What am I missing here? The risk that can be diversified away. I'm not counting. If I can somehow get a measure of how much of the risk in a bookstore is coming from that firm-specific risk component, then I might have a way of adjusting the cost of equity for that. Let me show you the page that I had. So these are all the numbers I pulled for public companies. Look at what I pulled up in the last column. I have the R squared for each company. Remember what the R squared measures? The proportion of the risk in of the variance in your stock that comes from the market, right? So across the bookstores, the median R squared was 26%. So for a typical book company, 26% of its variance comes from the market, 74% from the firm. The beta that I'm capturing captures only the market risk. It's missing the rest. If I can somehow bring in the rest, I'll be home free. So here's what I devised, and I won't say derive because that suggests too deep, deep thought. It was just concocted on the spot. I said I have a beta for this company. It's 0.8558. That's a levered beta I'd have had as a publicly traded company. 26% is the R squared. The square root of the R squared obviously is the correlation. And the reason you have to work with correlations is beta is a standard deviation measure. It's not a variance measure. So roughly 51% of the standard deviation of a publicly traded company comes from the market. 49% comes from the firm. Make it 50-50. So my beta of 0.8558 captures only the half of the risk, which is market risk. She's exposed to the other half as well. Do you see what I'm going to do? I'm going to essentially scale up the beta to capture the rest of the risk. I call this a total beta because I'm trying to capture total risk rather than just market risk. Total beta as opposed to a market beta. Market beta captures only market risk. A total beta captures the rest of the risk. It's scaled up to capture the fact that she's not diversified. So I end up with a beta of about 1.68. I plug it in. I come up with this cost of equity of almost 12%. And that's the number I called her and delivered to her as a hurdle rate. I said it's about 12%. She wasn't surprised. We went through the process. She might not have fully got the notion of beta, but she got the sense of what I did. And then she asked me two questions. The first, I knew the answer to, was easy to answer. The second, I knew the answer to, and I couldn't think of a kind way of giving her the answer. The first question you asked was, hey, Barnes & Noble, opening down the block from me, what's their cost of equity going to be? What's the answer to that? Barnes & Noble, publicly traded company. Their investors are diversified. Their cost of equity is going to be close to 7.5%. So I said their cost of equity is going to be 7.5%. And then she asked me the second question. She said, if their cost of equity is 7.5% and my cost of equity is almost 12%, how the heck am I going to compete with these guys in the long term? And what's your honest answer to that question? You cannot. And if you carry that through, here's what's going to happen. When I moved to New York City, there were probably 50 independent bookstores in the city. They're all over the place. Shakespeare and Company, and you can go down the list. Today, there are probably 5 independent bookstores left in the city. Maybe 4. You're saying that's because people don't read as much, they buy things online. That might be true. 50 years ago, if you walked into a pharmacy, 30 years ago, if you walked into a pharmacy in the US, the owner of the pharmacy was usually behind the counter. Most pharmacies in the US were run by their owners. The pharmacist was the owner. Today, you walk into a pharmacy and you look up, what do you see? You see CVS, Duane Reade. It is a public. In business after business, this is inexorable. Public companies will push private companies out of the space, not because private business owners don't work hard. They actually work harder than the public, but they're being inefficient about the way they take risk. This is terrible news if you're an entrepreneur, right? Because what do you do as an entrepreneur? You take your entire wealth and you put it into one business. And I'm just saying that's not a great way to take risk. You know that. But what you're hoping for if you're an entrepreneur starting up a social media company or a technology company, what do you hope to do? You hope to take it public, or you hope to sell to a public company. You essentially have that exit strategy out there and say, if I can only last 5 years, this is going to be okay. But during those 5 years, you're taking on risk for which you're not going to get rewarded sufficiently. And you're okay with it because you think the exit value will be large enough. But in businesses, I mean, my neighbor in the town I used to live in, New Jersey, ran the 5 and dime store in town. You know 5 and dime stores? The old Woolworths. You basically can go in and they carry everything. I don't even know how they maintain inventory. They had 3 of everything on the face of the earth, from kitchen stuff to almost groceries. Private business. She had her entire wealth invested in that business. Not a great way to take risk, and that's what you're fighting as a private business owner. Which actually means that this is not going to be the last business you're going to see private companies pushed out of. Real estate, it's starting to happen too. Real estate used to be the last bastion where developers in towns essentially controlling the business. But REITs and MLPs are pushing out private business owners. Here are the places private businesses will stay. First is, if you're a first-generation private business owner who gets an emotional dividend from running the business. You know what the emotional dividend is? You like running the business. This is your business. You built it with your sweat. You're okay with the fact that you're earning 9%, whereas if you took this money and invest in a mutual fund equivalent risk, you could make 18%. You're saying, but I won't get as much satisfaction. So that's the first scenario. The second is if your private business is in a niche. There's a bookstore up near 26th Street, I think, which is called the Mystery Bookstore. The owner of this bookstore, I swear, has read every single book in that bookstore. So you walk into that bookstore and say, you know what, I really like Sue Grafton. She'll name 3 other authors. Have you tried Kathy Wright? So in a sense, she can give you suggestions on books to write. So if you're a mystery book reader, you go into that store knowing that you're going to be paying more than you'd pay on Amazon or at Barnes & Noble, but you're okay with it because you get that personalized advice. You walked into Barnes & Noble, you go to the cashier and say, I like Sue Grafton. You know what the cashier is going to say? I don't know who the hell Sue Grafton is. Why are you telling me? The Harry Potter books are right there. Get one and get out of here. Right? So niche businesses, you will see. Or once in a while, you will see a private business kind of last because their family connections and getting out of the business is really entangled. Right? About 3 years ago, the MBA auctions, the one thing I can offer is I'll value a company. And so every year somebody picks it up. But 3 years ago, somebody in the MBA class picks it up. And so I expect a small startup, young business. He walks in with this huge stack of documents. So what the heck is this? Right? He said, I want you to value my company. And so what do? He says, we manufacture rum. And I look at that stack. I say, are you from Miami? He says, yes. Stomach drops. I know exactly what company he's going to tell me he wants me to value. You know who he wanted me to value? Bacardi. This is $1 billion company and he's getting this for $1,500. I said, if I'd known you want me to value Bacardi, I'd have probably added 2 zeros to that price. But let's face it, Bacardi is a private business and it probably has no business being a private business anymore. Maybe you drink so much of your own rum, you have no idea how much risk you're taking. It all passes, it becomes a haze. But you can have private companies hang in, but it gets more and more difficult with each consecutive generation, right? Because the first generation says, this is my business, we're not going to sell it to somebody else. The second generation feels close enough to the first generation not to sell. You get to the fourth generation, they say, what the hell are we doing? Just sell it, I can hang out in Monaco for the rest of my life with this money. So think about that when you think about private businesses. If you have a family-owned business, this is a constant challenge. Is because you have to work harder and harder to make up for the hill you're climbing or the mountain you're climbing because you've taken on all this risk. Any questions on private company valuation? Yes?
So how do you look at different industries where it's more or less common, like major players who are private?
It's a matter of time, right? Because pharmacies 30 years ago would have said, hey, This is the reason we have private businesses, is the nature of record keeping and trust, which is the pharmacist was somebody you went to actually ask questions. Today you walk into CVS, you ask the pharmacist questions. They might give you an answer, but it's in the context of, will your insurance pay or will your insurance not pay? The questions. So I think that as businesses get less personalized, this is something you're going to see. So the last bastions of private businesses will stay personalized businesses. You know.
How about in big B2B, like in agriculture, Cargill and Bunge?
And that's happening, right? Increasingly, it's tougher and tougher to be an independent farmer. And what holds on is that emotional dividend. So if you look at the Midwest and you look at somebody who's a third or a fifth or a 10th generation farmer, the only reason they're holding on to that farm is no longer that they can make a sufficient return, is that they have roots in that business that go so deep that they don't want to leave. And even there, you're going to see potentially public companies take over more. And that's actually one of the laments of independent farmers, is it's becoming corporatized, right? So there will be bastions of private businesses left in almost every business, but they'll get smaller and smaller. Asia and Latin America, much of the economy is still private. Why do you think private equity investors are going out there looking for businesses to invest in? Because that, in a sense, gives you that intermediate step, right, where you don't have to go public, but you sell off half your business to a private equity investor. I was in Chennai about 5 months ago, and we were driving by these small stores, and many of these small stores, these are small retailers, have private equity investors who bought out half the store. So they can now take that cash and invest it in a mutual fund or wherever else to get diversified. Okay. Yes?
If this was a private conglomerate with presence in multiple industries?
That's the other, so that's actually a very good question. There are two ways you can deal with staying a private company. And for 100 years, family-run businesses in Asia and Latin America decided that since they could not go public, you didn't have that option in 1940 or 50, the way they were going to make themselves more diversified was to actually spread their tentacles across multiple businesses. So you look at family companies in Asia, they're in everything. They're in steel, they're in chemicals, they're in financial services. That is the way they survived before public markets even opened up. So that's the other survival mechanism you can bring in, is to get diversified. But that's not a choice that a young startup owner has. They were able to do that because they were protected from competition. And they didn't have a public market to compete with. It'd be very difficult to build something like that from scratch today, given that you're already competing in public marketplaces for most of your products.
But while you're valuing it, do you do this adjustment?
Yeah, it'll show up, right? Basically, as you get more diversified, what's going to happen to your correlation? What's the definition of becoming a conglomerate? You're going to start to move more, so the correlation is going to take care of it. You will still do the adjustment, but the adjustment effect will get smaller and smaller. So think about this for your company. Try to look at the businesses your company's in. Try to come up with the bottom-up beta, because it's central to coming up with the hurdle rates, not just for your company, but for the businesses your company is in. Okay? So work on that when you get a chance. I know this is something, again, you're going to put off till after. That's fine, you know. But I have the in practice webcast I put on doing a bottom-up beta for United Technologies, which is like a mini GE. It's in 6 very different businesses. Take a look at it, because if you're confused, maybe it'll give you some help. So now let's talk about the other way you can raise capital. All of this talk is about raising equity, right? But there is another way you can raise financing, which is to borrow money. So I'm going to start off with a very simple question, a question to which I think you already think you know the answer, but let's see if you do, which is, what is debt? You're saying, I know that. Just go look at the balance sheet. If it were only that simple. So I'm going to give you the 3 criteria I go looking for to classify something as debt. First, debt gives rise to a contractual commitment. See what I mean by contractual commitment? I issue shares. You might buy my shares expecting to get a dividend, but it's not contractual. If I don't pay a dividend, you can't sue me. But with debt, there's a contractual commitment. Second, in much of the world, maybe other than the Middle East, that contractual payment you make will be tax deductible. I just did my taxes yesterday, and interest expenses are tax deductible still. Thank God for that. It's tax deductible. And third, if you fail to make that contractual payment, bad things happen to you. Like what? Your knees get broken if you're borrowing from a money lender, but if you're a company, the equivalent of your knees getting broken will be you go bankrupt. Fixed payment, tax deductible, loss of control. You ready? I'm going to list out items from a balance sheet. You tell me whether they meet these criteria. Corporate bonds. That was an easy one, right? Coupons are contractual, they're tax deductible for interest, and if you don't pay them, you go bankrupt. How about long-term bank loans? Long-term bank loans. Absolutely, right? How about short-term bank loans? The reason I separated the two is I'm amazed at how often I see cost of capital calculations where people count only long-term debt. What are you trying to tell me? If you borrow short-term, you don't have to pay it back. All interest-bearing debt is obviously debt. There's no ifs and buts about it. It's obviously debt. Now let's get to the trickier questions. Accounts payable or supplier credit. It's a big item for many companies, right? Should I count that as debt? It could be billions for some companies. If no, tell me what criterion it fails on. It is tax deductible. You know when it becomes tax deductible? When it becomes cost of goods sold, right? Because accounts payable, when you pay it, becomes cost of goods sold. So it is tax deductible. It is?
No interest.
It is non-interest bearing. Let me take that back. It does not have an explicit interest expense. What am I talking about? How do you get supplier credit? You buy something from a supplier. He says, you can pay me right away. You can wait 60 days. He's not stupid. So to get you to pay right away, what does he offer you? Usually a discount. The interest payment on supplier credit is actually lost discounts. About at least a couple of times every month, I'll get an email from somebody valuing a company with big accounts payable. And he says, look, I'm very uncomfortable not counting it as debt. There's billions of dollars of accounts payable. Can I count it as debt? And my response is already pre-programmed. It's actually one of the keys I can hit on my... And here's what it says. You can count it as debt if you're willing to go back into the financial statements and figure out how much discount they lost last year because of it and count that as interest expense. A day later, I get an email back from the same person saying, I've changed my mind. You can see why, right? You go into cost of goods sold, say, how much discount? How do you ever even back it out? So accounts payable and supplier credit are liabilities, but they're not going to count as debt when we do cost of capital. But I'm not done. There are items off the balance sheet that might meet these requirements too. Let me not be mysterious. If you're Target and you open a new store, what do you have to first do? You have to find a store site, right? But you don't want to buy real estate and build the property. You usually lease the property. On a 12-year lease or a 15-year lease, US retailers typically work with 12 to 15-year leases. So how does a lease contract work? You agree to pay $2 million every year for the next 12 years, right? Contractual payment, yes. Tax deductible? Lease expenses are tax deductible. And what happens if you fail to make a lease payment? Initially, you lose that site. But if you fail on a bunch of leases at the same time, what will happen to you is what happened at Bradley and Cardor's, two discount retailers. They were forced into bankruptcy because they failed on a bunch of operating leases at the same time. Lease commitments are debt. I don't care how accountants dance around it. Finally, accountants are coming to their senses on this. In 2019, both IFRS and GAAP will finally decide to treat all leases as debt. You know when they first started talking about doing this right? 1949. That was I found actually an announcement for a panel for accountants at Stern, or it wasn't called Stern then, and the NYU Business School then, about whether leases should be treated. 1949. When are they finally acting? 2019, 70 years later. You know what lesson you take out of this? If you wait for accountants to do the right thing before you react in finance, it's going to be too late. So start treating leases. Don't wait till 2019. If you're valuing or dealing with a Target or a Walmart or a Gap, you have to deal with leases as debt. So that's the first piece, and you can already see it can get messy. Now let's talk about the cost of debt. Let me lay out what I think you are trying to measure, and then let's talk about ways you might measure it. The cost of debt is the rate at which you can borrow money long-term today. We repeat that again. The cost of debt is the rate at which you can borrow money long-term today. Two key words there. One is long-term. You know why I put it in there? If I let my cost of debt be determined by the interest rate you actually pay on what you borrow today. given that you got an upward sloping term structure, you know what that means? Short-term debt is usually cheaper than long-term debt. You're going to take on all the short-term debt and say, look, my cost of capital just went down because I borrowed at 2%. I'm not going to let you play that game. So even if you borrow on 6-month loans, on commercial paper, I'm going to attach a long-term cost to it because you've got to roll this rate over, and I've got to essentially assume that the rolled over cost is going to approximate your long-term cost. That's the first. Second, it's a rate at which you can borrow money today. As opposed to what? Don't show me the bank loan you took 2 years ago. So look, I got a nice 3% rate on that loan. I don't care. It's a rate at which you can borrow, and it makes your life incredibly simple. So let's say you're a corporation and you're going out to borrow money in US dollars for 10 years. Let's make the long term 10 years. Let's make it explicit today. What's the minimum that you'll have to pay? It's in US dollars. Why do you think I gave you the currency? Because you need a risk-free rate. The risk-free rate in US dollars, we said, at least assuming the US Treasury is default-free, is the 10-year bond rate, which is about 1.8% today. So you're going to start at 1.8%. You're saying, what if I'm ExxonMobil and I'm really safe? It doesn't matter. You can't be safer than risk-free, right? So 1.8%. On top of that, I'm going to add a default spread, even if you're the safest company in the world. Why? Because you don't have a printing machine in your basement. The government that has the printing machine is going to be safer than you, so I'm going to add a default spread. How much will that default spread be? It will depend on how much credit risk I see in the chance that I will not get paid. So in fact, the cost of debt is far simpler than the cost of equity. It's a risk-free rate plus a default spread. If I can find a way to estimate that default spread for your company, I'm home free. So let's start easy. Let's say you're a company which has bonds outstanding, and those bonds are traded and liquid. Why trade and liquid? Because then I can trust the price, right? It's not coming from somebody saying it's probably worth 85. There's somebody willing to pay it. You know what I can do to get your cost of debt? If I know the price of the bond, what can I back out of it? The interest rate on the bond or the yield to maturity. That yield to maturity is your cost of debt. That is the easiest scenario. But here's the problem with using a yield to maturity on a bond to get the cost of debt for a company. Can a risky company issue a safe bond? Actually, yes. You know how? You take your safest assets, use them as collateral for the bond. You can be a risk. So the problem with you saying the yield to maturity in a bond is, I have no idea what's backing this bond. You could be a risky company, and you might have created that's why ratings agencies actually rate both the company and the bond. You can have different ratings. So here's what I'm going to do instead of trusting one bond to deliver the cost of debt. If you have bonds outstanding, you probably also have a rating as a company. Moody's rates you, S&P rates you. Here's the tricky part. If I trust the ratings agencies to get the rating right, I can use that rating to come up with your cost of debt. Why? Because if I know you're BBB rated, I know the typical default spread for a BBB rated company. I can add that onto your risk-free rate. I've got your cost of debt. That's the second scenario. Slightly more difficult than the first one, but not by much. But you know, 90% of all companies globally don't have a bond rating. This is especially if you count Latin America, Asia, Europe. Europe is actually worse than Asia and Latin America when it comes to ratings. A lot of European companies borrow from a bank. They have no rating. You still have to assess a cost of debt. So there I'm going to take my third option and act like a ratings agency and attach what I call a synthetic rating. Sounds incredibly complicated, but I'm going to use a very simple way to come up with that rating. All of these, I'm trying to come up with a rating to come up with a default spread. Adding that default spread to the risk-free rate gives me a cost of debt. And the one thing I have to remember is I have to do this in the same currency I chose to do my cost of equity. Remember for Vale, I said I'm going to do everything in US dollar terms. The cost of debt, I'm going to do everything in dollar terms as well. So ready? Let's start with the three companies where I have the easy option. For three of my companies, there's actually a rating I was able to pull up from S&P. So Disney and Deutsche were rated single A. Vale was rated A-. Remember what I said, if you can give me your bond rating, I can tell you the default spread. The typical default spread in November of 2013 for a single A rated company was 1%. For an A- rated company, it was 1.3%. How do I get that default spread? I look at other bonds with that same rating, look at what they trade at. And actually, I'll give you a couple of sources where you can look this number up right now. It's updated every day. So that's where I'm getting the spreads. I add that onto my risk-free rate, whichever currency I'm working with. I've got my cost of debt for these companies. So that was easy because I had a cost of debt. In the case of Vale, that's a dollar cost of debt. If you wanted a nominal real cost of debt, it's easy to do, right? Remember how we use the inflation rates, 9% and 2%, 9% in Brazil, 2% for the US? I do the same thing with the dollar cost of debt. I end up with a nominal real cost of debt. So if I want to go from one currency to another, I do exactly what I did with my cost of equity and use that differential inflation. So that's my cost of debt for my 3 companies that do have a rating. Bookscape? Yeah, go ahead.
Are you excluding short-term debt?
I'm not excluding it. I'm treating it like long-term debt. So I'm saying if you use short-term debt to fund it, I'm going to assume the rolled over cost of that short-term debt will be the long-term cost of debt. I have to do that. Otherwise, I'm going to let you play games as a CFO. We use short-term debt as a replacement for long-term debt and say, trust me, I know what interest rates are going to do. I don't trust you. If you know what interest rates are doing, fine for you, but when I do my cost of capital, the rolled over cost of short-term debt I'm assuming is equal to the long-term debt. Okay? So now let's look at the companies for which I don't have a rating. Yeah.
So when you're calculating cost of debt in real terms, can you still use the risk-free rate of 2.75% because your original number is coming from?
No, but when you scale it up, it doesn't matter, right? What effect is, why do risk-free rates vary? Because inflation rates vary. If I'm adjusting for the inflation, I'm effectively replacing the risk-free rate with a nominal real risk-free rate. I can't do both. I can't use a nominal real risk-free rate and use an inflation adjustment. That will be double counting. So use one or the other. You'll get pretty much the same answer because inflation is the only trump card that causes currencies to be different. I should be careful about using words like trump card. I'll be violating somebody's... So now let's talk about the companies for which I don't have a rating. When I first started trying to do this and saying, I want to be like a ratings agency, the first thing I said, I want to have my head examined. Why would I want to be like a ratings agency? But I had no choice. I had to think like a ratings agency. And luckily for us, ratings agencies are the most transparent organizations in the world. That sounds like a weird thing to say. But what's the output you get from a ratings agency? They give you the ratings for every company they rate, right? So they say these are the 1,800 companies we rate and here are the ratings. And then they give away the game. And here's what I mean by giving away the game. If you go to the S&P website, they list the 8 financial ratios they claim to base the ratings on. Like things like EBITDA to fixed charges, interest coverage. So here's what I did the first time I tried to be like a ratings agency. I took out every company that had a rating, put it in the first column of an Excel spreadsheet. And the next 8 columns, I set up the 8 ratios. And then I did some reverse engineering. You know what I mean by reverse engineering? I basically sorted the ratings from AAA down to D and tried to figure out which ratio. So you can tell me you have a secret formula, but since you've given away the output, I can back out what you're using to come up with the rating. And here's what I found. With non-financial service companies, banks and insurance companies are a different game altogether. With non-financial service companies, one ratio seemed to be doing the bulk of the lifting. It was the interest coverage ratio. The interest coverage ratio is operating income divided by interest expense. So for instance, for my 4 companies, here's how I got the interest coverage ratio. I took the operating income in the most recent year, and you can take issue with that because that number can be volatile, divided by the interest expense. There's my interest coverage ratio. Remember, as a lender, you want this number to be as high as possible because it gives you buffer. And it looks like, if you look at ratings, this is the ratio that drives almost 50% of the variation in ratings across companies. You're saying, what about the other 7? The other 7 ratios put together explained another 15%. So if my job were to actually be a fixed income person, which it's not, but if it were, and I wanted precise ratings, I could create weighted scores with all 8 ratios. Because I want a precise rating, I don't want a precise rating. I just want an approximate rating. So given that I can live with being within shouting distance of the actual rating, I said I'm going to build my rating on one ratio. You tell me your interest coverage ratio, I'll guess your rating. So starting about 20 years ago, I started creating these lookup tables based on rated companies, where if you tell me what your interest coverage ratio is, I'll guess your rating. So rather than deal with this in the abstract, let me try to convert these interest coverage ratios into ratings using the table I had in November of 2013. Here's the table I used. In the first column, you see the ratios for large companies, where large is greater than $5 billion in market cap, And second column, you see the ratios I use for small companies. Why two different sets of rules? The life's not fair. If you're a large company, you get a higher rating for the same ratio than a small company. So let's start with Disney. Large market cap company, market cap of 130 billion, so clearly it's a large company. 22.57 interest coverage ratio, so I go to that first column, it's way above 8.5. So I'm going to give it a AAA rating. Hold on, I know Disney doesn't have a AAA rating, but based purely on the interest coverage ratio, its rating should be AAA. For Vale, it's a large market cap company, or at least it was. When I did this in November of 2013, it's kind of slipped since then. But because it's an emerging market company, I actually use the small cap ratios. Why? Again, because life's not fair. If you're an emerging market company, you get judged more harshly than if you're a developed market company. 11.67 puts them right there. That would give them a AA rating. You know what Vale's interest coverage ratio looks like right now? It's 2.5. So if I were assessing a rating for Vale right now, 2.5 would actually put me right there with a single B rating. The truth probably lies somewhere in the middle, because in 2013 I was catching them after a really good year. In 2016 I'm catching them after a really bad year. And if my job is to normalize things, I'd say right now they'd be lucky to get a BB plus rating given where iron ore prices are right now. With Tata Motors, large cap emerging market company, 4.51, that puts them just above the threshold for an A minus. So there's an A minus rating. Baidu, small cap emerging market interest coverage ratio is through the roof. I give them, you're saying, no way will Baidu have a AAA rating. I completely agree. You're going to see why I'm not going to waste any time finessing this. You know why? Because Baidu has only 5% debt and 95% equity. You've got to save your fights where it actually matters. This isn't where I want to waste my energy saying, should it really be AA or single A? Frankly, it's not going to matter that much. And finally, for Bookscape, with that interest coverage ratio of 5.16, the rating I give is A minus. So when you get the interest coverage ratio for your company, I'll give you the link to this lookup table. You can get a synthetic rating for your company. Check it out. If nothing else, for my 3 companies where I had an actual rating, I had now something to compare my synthetic rating to. For Disney, for instance, their actual rating was single A. I gave them a AAA rating. But there's a simple reason. I based everything on the 2013 number, and Disney had a really good year in 2013. My guess is that the ratings agency is being a little more prudent and saying we should average things out. For Vale, my rating was AA. The actual rating was A minus. There the reason is actually simpler. Vale is a Brazilian company. You're saying, so what? For the longest time, ratings agencies had what was called a sovereign rating ceiling. Have you heard of this? It's the most unfair thing in the face of the earth. That no company in a country was ever allowed to have a rating higher than the country. Can you imagine being a Venezuelan company right now? Your ceiling is going to be set at what? Single B, triple C. It was unfair, but ratings agencies said, if you're an emerging market company, we're going to punish you. They still do it. It's not just as explicit. So that's the A minus. And for Deutsche, I left the rating where it was. I have no idea what the synthetic rating is. There's no ratio that works with financial service companies. So I'm almost home. Let me finish on this page, and you can see what the last step in this process is. I have a cost of debt, right? I know what it costs to borrow money. But I also know the tax code is tilted in favor of debt. In what sense? I just told you I did my taxes, and interest expenses that I have are tax deductible. What does that mean? When I borrow money at 5%, if I have a 40% tax rate, in effect I'm borrowing money at 3%. Why? Because I pay the 5% interest, I save $2 in taxes. So to get my cost of debt, I'm going to multiply the rate at which I borrow it by 1 minus the tax rate. Saying which tax rate? If you open up a 10K for a company, you'll see a tax rate report. It's usually an effective tax rate. What's an effective tax rate? Yesterday when I finished my taxes, I used TurboTax. It took me like 3 hours. At the end of 3 hours, the final statement it leaves me with, congratulations. I should really be jumping up and down. This year you paid 25.13% of your adjusted gross income as taxes. Don't read too much into that. No, you're already figuring out this guy must make much money, 25%. And you have no idea what I made income on. So maybe I'm just hiding income in places you don't know. Maybe I have an Irish sub I've created. Okay. That's an effective tax rate. What our TurboTax does is it takes my taxes paid divided by adjusted gross income. That's what an effective tax rate. It's an average tax rate across all your income. That is not the tax rate you should be using for cost of debt. It's a marginal tax rate. What's your marginal tax rate? It's a rate at which you can borrow. It's a tax rate on your last dollar of income. And the reason is simple. If I have $1 million in income and $100,000 in interest expenses, think of what happens. I subtract the 100,000. I report 900,000 in taxable income, right? I saved on my last 100,000. I'm going to leave you with a really depressing thought. How many of you plan to work in New York City after you graduate? Okay, here's my depressing thought. Let's start thinking about your taxes when you graduate, right? Let's first put you in an income bracket where you think you deserve to be. How about 200,000? Is that reasonable? Okay, let 200,000. If you feel that's too low, keep adding zeros. It's only going to make life worse for you from a tax rate perspective. $200,000, your federal marginal tax rate is 36% because you're going to hit that 36% bracket. Okay? See, that's not too bad. I'm not done yet. You're making that income in New York. The marginal tax rate in New York City on 200,000 is 8.5%. So 36 plus 8.5. You get a little bit of tax reduction for state taxes, but not that much. So now you're at 44.5. I'm not done yet. I'm assuming that if you work in New York City, you don't plan to live in Jersey City and commute. Because you're in New York, you're making 200,000. That's another 3.5% in city taxes. So that's now going to be around 47.5. There's a 3-point-something% tax for the new healthcare plan. So that's a marginal tax rate that will kick in on to. So we're already pretty close to 50%. It's only a matter of time before Chelsea decides that if you live in Chelsea, it's another 2%. It's almost like people are lining up with clubs outside your apartment. They come on out and slugging you one after the other. So when you get your first paycheck, you are going to be shocked at how rich you are, at least in terms of the tax rate you pay. So where did that money go? You know what you should learn from that? If you live in New York City, borrow money like crazy. Because your interest tax deduction will save you at the margin 51%. Okay? So when I do my after-tax cost, that's what I'm doing. I'm netting out the marginal tax rate to get the after-tax cost of debt for these companies. So when we start on Wednesday, we will complete debt and the cost of capital. No?
I don't know if you reuse the same slides, but I think you had a typo in your review session. Right here, just when I calculated that, I get a slightly different number. 0.6, that's one, so 1.6 times 0.864.
What do you get?
I get that, 13 point
I'll check it out.
total. So if you divide by 0.864,
Take 0.864 times 1.6.
oh, times 1.6? Yeah.
That's rounding. So that's from 0.864 is 0.863 something, right?
Okay.
No. So that's just the rounding. So when you got 1.36, I was worried. But 1.3824, I think that's just pure rounding because the Excel spread. Because in Excel, when I do that 0.864, it's probably 0.863 something, and that effect alone would explain it.
We increased beta for the bookstore because she's concentrating all the risk in that thing.
Exactly.
But if we're a private equity and we buy
Because you plan to exit by selling to a public, private equity investors never think like private business owners. They are thinking like public owners because their entire plan is to flip it over. The other thing, you should never do that because you're never a private business owner. And the other thing is you're a private equity. Like KKR Blackstone, you have 50 holdings in different businesses. You hope you get that. But really the exit strategy is what you're thinking about.